Welcome today. My name is John Mazzara. I'll be teaching the class on Twin Cities first-time home buyers, and we're going to go over some of the mistakes that we don't want you to make, and we're going to give you lots of information. We'll be opening it up to questions and answers as well, periodically as we go. I'm going to try to make this 1 hour, and if you have additional questions that are beyond the hour, you can certainly reach out to me after the class via phone, email, or however you like to communicate, text or otherwise. So with that, let's get started. So as a first-time buyer, you might be feeling confused, stressed, concerned, intimidated, anxious, not sure where to start. So after this class, I want you to have all of those feelings go away, and I want you to feel confident and ready to hit it. Okay, about myself, I've been selling homes for 39 years. I graduated from St. John's, and I've been selling homes ever since. Sold over 1,200 homes all across the Twin Cities. I'm very knowledgeable about both sides of the river. So I work east and west, north and south. I work with buyers, sellers, and investors, and I'm very familiar with all the loan programs and lenders so that I could match you, if you would like me to a lender that might provide what you need. You can Google me, and I have plenty of references that I'm happy to share. Okay, what agents do is a lot behind the scenes. So we try to make the process as easy and fun as possible, but this gives you a list of 111 things that we actually do that you may not be aware of that we do. It's much more complicated than simply opening up a door and filling out some papers. But a lot of times you don't see that. So that's why I have this page so that you can understand all of what goes into buying and selling a house. When you work with an agent, one of the first things that you're going to be exposed to is the agency form. And this just gives you a breakdown of everybody's duties. So there's somebody that represents the seller, somebody that represents the buyer. Sometimes the agent or the company will represent both buyers and sellers, and that's called dual agency. And sometimes we just fill paperwork out based on a previous agreement that you may have had with somebody else. So you're working maybe with a relative, family member, for example. They want to sell you their home, you want to buy their home, but you don't know how to take it to the next step to get to the finish line, and that's called facilitation. You'll notice line 76 to 80 give you a resource to look up the location of a registered sex offender. That's a non-disclosure item from the sellers. So if somebody is a registered offender and you didn't want to live next to them and you feel like the seller should have told you, they're not required to. All that's required is that you're given this website and phone number, and then to the extent that you want to do your due diligence, you can research it further. So the seller is under no obligation to disclose that. Then, before you can get into a house, under some rule changes, you now have to either sign a buyer contract for representation or sign a limited showing agreement that expires in approximately 7 days. So you can't just show up and be showing a home. You can go through an open house, however, and not be under anything contractually. But otherwise, before you can view a home specifically, you have to have the showing agreement with the agent or the buyer contract for representation. One of the spots that we can provide research for you on both a macro and micro basis is mplsrealtor.com. Now, I happen to have here the 13 county Twin Cities region, so that's a macro footprint, but I could have drilled down and shown you Egan or Apple Valley or Eden Prairie, Edina, or I could show you within a community like Minneapolis or St. Paul. I could show you the individual neighborhoods within those communities. So we can go granular and micro, or we can go macro. I can do it by county, I can do it by city, I can do it by region. What are the steps to buying a home? Well, first of all, coming to a class like this so that you can learn the process. Then you're going to work with the lender of your choice to get either pre-approved or pre-underwritten. Underwritten is better because more things have been verified. They verify your pay stubs, your down payment, your employment. All of those things are done generally during the underwritten process. So all that's left is finding the property itself, the appraisal, and the title work that comes with that. A pre-approval means that you look good, but we haven't vetted and verified. And If you're a seller, you would prefer the underwritten approval versus the just qualified, looks good approval, because then you know that that person, unless they lose their job or do something different with their credit, should be able to complete the transaction. We're right now in the spring market, and the spring market is the busiest, most competitive. So one way to give yourself an edge is to have an underwritten approval. The types of loans that are going to be open to you, there are more than these, but typically the most common are conventional, VA for veterans, and FHA for everybody. So everybody can get a conventional loan or an FHA loan, but only veterans can get a VA loan. As a first-time buyer, you might want to be utilizing some down payment assistance, and that varies both from statewide programs to individual county programs to specific area median income requirements. So there's all sorts of things that are going on with down payment assistance. But in my 39 years of selling homes, I have never seen more programs than I have at present. So there are lots of opportunities for you to find money if you need it. Then once you've gotten your approval, then you go out house hunting with your favorite agent. Excuse my dog in the background here, I'm trying to hush him up. But you'll need to pick a lender that does down payment assistance if you're looking for down payment assistance. And not all lenders can do all of the programs. So one of the things that I like to do is research with you the right lender and the right program that might match what you're looking for. Then we go out hunting for a house based on your criteria from your approval. Once we find the perfect home, we'll make an offer on it. And if you like it, unfortunately, probably somebody else does, and we may get in a multiple offer. If that happens, I'm going to give you my special tips and techniques to win. But usually it comes down to money, and whoever is willing to pay most is usually the winner of that particular home, but not always. From that, after we win it, we may have an inspection. It's up to you. We'll go over some of that. And then you order the appraisal, the title work, and all of your loan documents are finalized, and they re-verify what you initially provided, such as current pay stubs, current bank statements, and your current credit. Then we go to a closing. Closing takes about 45 minutes. At the end, you are the homeowner, or the seller gets the check, and you get the keys. Then you get to move in. Here we see it graphically. So we're today at the top of the house getting educated, learning about the process. Then you're going to figure out what you can afford. You're going to shop for a lender and a mortgage, get yourself pre-approved or pre-underwritten. We're going to go out shopping for that house. We're going to find it. We're going to negotiate on it. You call in a home inspection of your choice, and there's about 5 different types you can do. We'll cover that as well a little bit later. And then your loan is submitted for final mortgage approval, which includes the title work being ordered in the appraisal. But there we go to the closing, and here's your party. We go over this one more time in the checklist. So we've seen it now about 3 different times about the process of how we go about buying a house. So the first mistake that I see sometimes is the buyer, if they're eligible for down payment assistance or grants, that they don't take advantage of them. So at least make yourself aware of them. You don't have to use them, but it would be a shame for you to figure out after the fact that there was something that existed that you didn't know that you wish you would have known. So, take a step back. Let's dig into the programs. If something works, then let's find that lender that can provide it. These down payment assistance programs work very well with Fannie Mae and Freddie Mac, which are the quasi-government sponsored enterprise that issues and underwrites conventional loans. And then we have FHA, which is an insured, government insured type of loan. In general, a first-time buyer is someone defined as somebody that hasn't owned a home in the last 3 years. So even if you owned a home previously, maybe you divorced or decided to enter the housing market as a renter for a while and want to go back into home ownership, if it's been over 3 years, you're going to qualify under most programs as a first-time buyer. Most programs have a requirement that you do take either in-person or online education. It's usually 8 hours to get that certificate, and each down payment assistance program will be slightly different. The approval from the class usually lasts about a year. But unless you like to take lots of classes, which I'm not discouraging you from doing at all, you normally want to wait to find the program first and then take the education that's required from that, because it's not one that works for all. There are ones that work mostly for all, but not all the time. So you may have to duplicate your education if you take the wrong training. So that's why you might want to wait first, look into the program, and then take the class that's associated with it. First time buyer program will teach you about budgeting and making sure that you're not overspending. What they want you to do is be successful. Nobody wants to take your home from you, meaning the banks are not in the business of foreclosing, they're in the business of lending money. And they want you to make sure that you don't overextend so that you can be successful. Qualifying in general is specific. Some of the down payment assistance program can be specific to your city again, can be specific to a neighborhood within a city, and it might be statewide. So the one that's very popular that's available statewide that doesn't run out of money is the Minnesota Housing Finance Agency, MHFA. All programs are going to be dependent on your income. You have to make a certain level. Maybe you can't make too much sometimes, or they disqualify you. Some of them are you can't, where you have to have a percentage of the area median income, meaning I can't be over 60% or over 80%. Other programs are up to a dollar amount, like up to $150,000, for example. So each program is slightly different on how they qualify, but they mostly have income requirements, and they all are dependent on having a minimum credit score. That credit score is variable, but normally what we're seeing is usually a 620 to a 650, with most of them being towards the 650 or better, in order to get and take advantage of the down payment assistance. Some are forgivable, meaning over a period of years, a percentage of that money is forgiven. Some are deferred, meaning you don't have to pay it back until you sell your home or refinance it in the future. And some are just loans or grants. Again, everything is dependent on your situation as you go forward. Here's an example of a hypothetical person named Anita, and Anita wants to buy a home for $250,000. She wants to put the minimum down 3%. So she would finance $242,500. She also has closing costs associated with that loan, and they're going to equal about 2.5% of the value of that loan amount. In aggregate, she's going to need, with the down payment and closing costs, $13,750. However, utilizing the Minnesota Housing Finance $1,000 program, that's all she'll need out of her own pocket. She'll get two loans at the time of the closing, one for $242,500 and one for $12,750, which covers all of the costs. So a lot of times buyers think that they have to save up a tremendous amount. They've been erroneously told they need 20% down to buy a house. It just isn't true. Under this example, you could buy a house with as little as $1,000 out of your own pocket if you use down payment assistance. Even if you don't use down payment assistance, you can see that you could buy a house using this conventional loan with 3%. So don't think that you have to wait years and years and years to try and accumulate the down payment and closing costs, because as you wait, those homes are continuing in general to appreciate, which means the longer you wait, the more expensive it will be. So I would encourage you to do home ownership yesterday versus tomorrow and start building equity of your own. In the MLS, and here's an example of one of my listings, there's a button associated with all listings, and you can see it's with a little dollar and a check mark. If you were to go to this property or any property in the MLS and click on that, that button would show you all of the programs that are applicable for that particular home. So if in our search, we can set it up and we can start looking at some of the different communities and areas, and we click through that and we find a program that predominantly is showing up that is of interest to you, then we want to make sure that you're associated with a lender that can provide that. There's a down payment assistance tool effectively that's coming from that link, and you can type in an address and do a general search from this spot as well. And this is from the Minnesota Homeownership Center under the down payment assistance search. My wife, Patty, works over at Wells Fargo, and they have a proprietary program. It's called Dream Plan Home. So maybe you don't want to use one of the other down payment assistance programs, or you don't qualify for it. Dream Plan Home is available to you. And you may qualify for this, and then Patty has access to other programs as well. But this one in particular is proprietary to Wells. I'd mentioned city programs. Here's one from the city of Edina. A lot of people think that some of the suburban cities don't have programs, and that's just not true. So here's one in Edina. You can get up to 25% of the value of the home, up to 90,000, and their income limit is over 150,000. So it's not a low income housing type of program. Woodbury has one, Minnetonka has one. That's in addition, of course, to the various city programs. So don't think that if you're looking in the suburbs that there isn't something that would work for you. There just might be. Now, as of this recording, both the city of Edina and the city of Woodbury are temporarily out of funds. Their funds ebb and flow depending on their funding sources or the recycling of their previous monies that are lent out. And so at present, those two cities are out of money, but that could all change and is expected to change in the very near future. I'd mentioned the Minnesota Housing Finance Agency, MHFA. Here are their down payment and closing cost assistant loans that they have. And you can learn more from their website, mnhousing.gov or MHFA. You can Google that. And then there's a new program, well, new as of last year. It's called the First Generation Homeowners Program. And there's the two main funders, and then there's other cities that have additional programs that are very similar, cities and counties. Right now, the program with 50 million is out of money. So that one's unavailable. But the community fund one with the 100 million still has funds available. And I've helped many people, approximately 5 people, use that program. And it's a great product, great program. 32,000 is forgivable at 20% per year over 5 years. But the key feature is you have to be a first generation homeowner, which means that your parents didn't own a home, that you've never owned a home, or if your parents did own a home, if they lost it due to a foreclosure, then that, well, then we pretend that didn't happen, and then you qualify again. So there are criteria there that on this particular program, it works different in the sense that you have to be pre-approved for the money and be assigned the money first before you can buy a home. Most other down payment assistance programs work by you buying the house first, then you make an application for the funds. But this program, you make application for the funds, you get assigned the funds, then you can go out and spend the funds. So it's a little bit different. Make sure that you understand that nuance if you're qualifying or wanting to qualify for this program. So here it is again, the first gen program, the 100 million. I think they're done with about half of the funds. And then when it's gone, it's gone. There's no guarantee this will be funded again. I think there's always monies and always programs. So I think they're going to have a new iteration of this in the future, but no guarantees. Right now, Minnesota is running a deficit. They created this program when Minnesota had a surplus. So I don't know how it will come back out again, if it will come back out again. So if you're a first generation home buyer, definitely look into this. Types of mortgages, again, are conventional, eligible for everybody. FHA, everyone is eligible. VA for veterans only. Now, underwriting guidelines vary depending on the loan types, and different lenders can put overlays over the lender requirements, which means if they think that the requirement for that loan is too loose, they can make it tighter if they don't want to take on that risk. So sometimes we'll find, depending on your credit score, that you can't go to this bank, but you can go to this other bank or broker because they'll accept the risk and the other one won't. As a general rule of thumb, we're seeing conventional loans being 620 and above. With FHA loans, we're seeing them 620 and above. FHA doesn't technically have a minimum score, and with a very large down payment, you might be able to buy a home with a score in the 500s. You have to have a reason why your score was there, and if that's acceptable with a larger down payment, the lender may accept that risk. VA usually is 620 or better. Conventional loans, they're they're not specifically guaranteed by the government at all, but the entities that create them, Fannie Mae and Freddie Mac, are what are called government-sponsored enterprises, and they underwrite according to their guidelines, and then private mortgage insurance by private companies is what insures that loan in the event of a default. So if you bought with 3% down, you're going to have private mortgage insurance because you don't have the 20% down. And then you make that payment as part of your mortgage payment. So you make a mortgage insurance payment, which protects the lender in the event that you default, then they will cover a percentage of the losses for that lender. So private mortgage insurance isn't for you directly, it's for the lender that's lending you the money. But without the insurance, you wouldn't be able to buy a home at a 3% down payment, for example. FHA requires mortgage insurance on all their loans for the life of their loan. So FHA, the insurance is a little less. It's not tied to credit scores. However, the only way to get out of it really is to put a very large down payment down and pay it for 10 years or to refinance it at some point in the future. So just consider FHA loans a loan that requires insurance. Conventional loan, you could get out of it after you paid it down to 78% or 2 years, and you can do an appraisal potentially to show the equity and get removed from it. So conventional loan, easier to get out of the mortgage insurance in the future without necessarily having to refinance it. Benefits of FHA loans, you can get into lower down payment. Again, it's possible to go all the way down to 500 with a very large down payment. It's all lender specific. You're not going to find a 500 score acceptable at, let's say, a larger bank, but you may with some of the brokers that are out there. With FHA, sellers can pay up to 6% towards your closing costs. Now, that doesn't mean they're going to, but they're allowed to. So depending on how the offer is structured, you can get more towards closing costs from the seller in the transaction if you use FHA, if that's necessary for you. Low mortgage rates in comparison to others, so they are oftentimes lower than a conventional loan. It depends on the day in the week, but FHA has a lower rate sometimes. They typically allow for a higher debt to income ratio with lower credit scores, and you can get a 15 or a 30-year loan or an ARM. Most people might be best advised to start with the 30-year amortization and then pay it down as their income allows for. So you could amortize it out at a shorter amortization if you can pay more towards principal. Down payment assistance programs are accepted by the program itself, but not all lenders accept them. So again, it comes back to which DAP or down payment assistance program do you want, which ones do you qualify for, and which lenders can provide them so that we can match you accordingly. Here's kind of a comparison again between the two. You see the grid comparing FHA to conventional. First-time buyers often lack the money needed. And so where can you get the money? Well, we talked about down payment assistance. You can also get a gift from your parent or a relative. You can potentially take a loan from your 401k. That loan or distribution is limited generally to 50% or 50,000, whichever is less. And if you have an IRA, you can take $10,000 towards a distribution and not pay the 10% penalty, but it will be taxed to you as income. Or the seller could pay the closing costs, and that could be from their proceeds, or hypothetically, we could raise the purchase price by the amount needed and have you pay a little more if the home appraises, and then have that additional amount go towards the closing costs. What you can't use is borrowed money. So you cannot go cash advance a credit card. You can't go take a loan other than a down payment assistance loan for the down payment. and you can't have mattress cash. So you can't show up with a briefcase and not have documentation of where that money came from. It's got to be introduced into the system and be there for at least 60 days. And or potentially you're going to have an explanation on why there was a large deposit and why it was cash. Um, when you're underwritten based on your ability and your willingness to repay, as well as the home and the collateral, which means your ability to repay is, do you have a job that generates an income sufficient to pay the mortgage payment? Your credit score is a great indicator based on your previous ability to handle debt and how you've paid it. That's why credit score is so important. That shows your willingness. And the collateral, meaning the home has to be sufficiently in good shape. Because if you couldn't pay for whatever reason and they had to foreclose, they need the home in sellability condition, which means that the home could be sold if they had to. They don't want a home that's in disrepair or torn apart, something like that. They need it to be a functional house. Okay, I'm going to skip through the questions and answers, and we're going to go over those at the end if we have enough time. Okay, mistake number 2 is not getting pre-approved before you view homes. Because inevitably, what's going to happen is you're going to find a house when you start looking and you're going to want it, and you won't be able to buy it because you've not begun the mortgage process. So in the spring market, especially when homes are moving very fast, you need to be ready and primed before you go look. And that means have that pre-approval letter in hand. You're going to provide this information to your lender. They're going to pull your credit, they're going to look at your income, and they're going to look at your down payment source. And then based on that, they're going to be able to generate either an approval letter that's a pre-qual automated letter or a fully underwritten, vetted, documented letter. With your pre-qualification, again, they're going to look at the most important things, which are your credit, your income, your assets, and they're going to try to determine what you qualify for, and they don't want you to fail. That's why you're not allowed to use all of your income towards a house payment. You're generally allowed to use up to 50%. If you have really good credit, they'll maybe let you push it a little bit. If you have maybe some credit issues, then they make you dial it back a bit. So they're approving you based on what you're showing them. Tips for a simple loan approval is call me, ask me any questions, and have that discussion with your lender of your choice. Continue to live where you're currently living. Pay your mortgage or rent as you've been paying, and use your credit cards as you've normally been doing. Keep the same employment and possibly the same employer. Keep everything basically status quo, at least until you close. Now, the moment you close, and the paper and the ink is dry on the paper, you can change those things, but don't make any big life changes during the process because that skews your credit and your ratios and your ability to repay. So all of that will be verified or can be verified by the lender all the way up to the day of closing. So what you don't want to do is make any changes during the process that could adversely affect you. So for example, you're a W-2 employee and then you decide to take a sales job on commission. That's going to throw everything up in the air because you don't have a history yet with that new career, that new job. Pre-approvals, the best kind are the underwritten kind where everything has been reviewed. It's much more reliable. It gets out any of the surprises. Can take a few extra weeks up front. The process moves as fast as you provide the documentation. The faster you move, the faster you'll get your qualification. The pre-approval allows you to shop with confidence because you know that you can do it. Your search criteria that I would create for you can be determined then based on that search, based on that approval. Your offer is then strong and the seller knows that you can complete the transaction if you can come to an agreement. And it eliminates that couple of weeks that would have otherwise had to have occurred during your purchase process. So it allows you to close quicker in the future. And there's a lot less surprises. And who likes surprises other than on birthdays? Okay, mistake number 3, using the wrong lender. Using the wrong lender can be expensive because not all banks, especially with the down payment assistance programs, are approved to use them. Many smaller institutions and credit unions have no interest in providing those programs. So the problem is if that's the program that you need and you're working with that institution, you're not going to hear about it. They're only going to tell you what they can provide. So if you're working with me, let's say as your quarterback, I can help direct you to other resources that might provide what you need. Um, when you go out to, let's say, the MHFA site, the Minnesota Housing Finance Agency site, they will list lenders right there. So you could pre-look up if that's the type of loan that you want, which lenders might or which are approved to offer that program. And if you see that your preferred bank isn't are on there, then maybe then you need to find a different bank. So it's all about balancing act. That's what real estate and home buying is. You can see there's lots of moving parts. It's not as easy as it might have sounded, but it all comes together. And a big part of it, which isn't really on the screen, is that as much as we like to make it just a financial and a numbers process, a lot of it is very emotional. So I reckon it falling in love. So if you've ever fallen in love, you just know. And it's like that when you buy your house, you just know. It's an emotional purchase that we try to make non-emotional as much as we can, but it always is an emotional process. Is a 30-year fixed rate always right for you? Not necessarily. If you're going to be in that house for a shorter period of time and you know that, for example, 3 years, 5 years, 7 years, 10 years, maybe an adjustable rate mortgage is preferred. Might give you a better rate if you do the ARM. Not always, but it's worth taking that look. So again, when you're buying a house and being coached and discussing your loan and your loan products, make sure that you're matching it to what your goals are. There's also an interesting product. FHA has one, conventional has one too. It's called the FHA 203K, which allows you to borrow money for the rehab of the home at the time of the purchase. So maybe you've discovered a house that's in the area you want. It's perfect, but it has an atrocious kitchen or bathroom or both. And you're like, boy, I would buy that house tomorrow, but I just couldn't live with those two things. Well, that's where a rehab loan product could come in. So with the FHA 203K, they take the home and they have you get bids based on the work that you want to do. They do an appraisal of the way it is today and the way it is tomorrow. And it doesn't have to be dollar for dollar on what you want to borrow. Just has to be a small incremental amount more. And then you close on the loan, the amount for the repairs go into an escrow account, and then those monies are released over a period of time as the contractors complete their work. And the bids are already pre-provided, so we know exactly how much to borrow because we've already got the bids to do that work, which we're then going to pay for out of that escrow account. So just kind of a twist you might not have heard about. It's not right for everybody, but it's out there. Also, some lenders have portfolio loans where they hold them in-house. Well, I don't know if you've heard the golden rule put to you this way, but the man with the gold makes the rules. So if the lenders have their own portfolio loans, they can choose on what they deem an acceptable risk, and they can do it their way. So sometimes we'll utilize portfolio loans and lenders that can provide them because you have a make sense situation, but it doesn't fit within the rules of the regular mortgage guidelines. So portfolio lenders are great, and there's a whole industry built around that that's out there. Some local at the local banks and credit unions, and some nationally. We have a whole what's called non-QM, non-qualified mortgage product suite, which works with borrowers that are self-employed or buying investment properties that are utilizing different types of financing. Mistake number 4 is buying from a builder without representation. So with regards to representation, the builder has the builder rep. You have a realtor rep normally. And if you're being represented and if the builder is paying your broker comp fee, why wouldn't you want that representation? So I think you do, and I think walking into a builder without representation, since you're able to reflect many times the cost of your representation back through the builder at no additional cost to you, I think that might be a mistake. So I would encourage you to work with your agent of choice in finding new construction if that's where your interest is, and then having that person work with you and the builder and represent you and register you at the time of visiting the builder. So the way it works is we set up your MLS search. And if you say I want new construction, then you're being sent homes that are new builds. And then when you express interest, we go with you over to the builder, one of the national builders, register you at that model home. And then we look at all the plans and the developments, and then we can compare and contrast this builder with that builder and help you make the right decision. So I think you're best served with some representation than without it. Um, the truth about buying directly from the builder, though, with regards to a mortgage is kind of interesting. Sometimes they may actually have their own lender or a block of money committed, and it may be cheaper than the lender you're working with. Sometimes we'll end up working then with and switching from your current pre-approval to the builder's mortgage company. The lender that you're working with won't be pleased necessarily, but they certainly will understand if there's a big difference in the rate. I'm not talking about an eighth or a quarter, I'm talking about a percent or more. So during this time when interest rates were a little bit higher, the builders were offering special financing incentives so people would buy their homes affordably. And that's something that I can help you make that evaluation with as well. So sometimes we'll switch and use the builder's financing. Most of the time you'll use the builder's title company, but not always, but most of the time you will, because they're working off of a master, abstract, or development, and they've got everything already done. So it's much easier to complete the transaction using the builder's title company. Mistake number 5 is skipping a home inspection, or at least let's have this discussion on when it makes sense to do it and when it makes sense not to. So I'll never tell you to skip a home inspection. It's always your choice. I think they are very valuable to do. However, if you're building new construction, remember that it's being built and things are being signed off on as they're completed. So the builder has to have somebody come out and check the framing, the plumbing, the electrical, the foundation. So it may not be as important for you on new construction to have a home inspection. You're also given something called a How 210 builder warranty from the builder in the state of Minnesota. So there is a warranty that's provided on new construction that isn't automatic with existing homes. So we'll get into that here a little bit more in a second. So the risks of skipping an inspection is that you're going to miss something. So especially on an older house, if it's old, let's call it over 20 years, there are some things, that might be starting to wear out. And some of that might be missed if you don't do an inspection. You're hiring an inspector to find problems, and they will. You would be upset if they blessed the home and gave you a clean bill of health. So you told them to find problems, they're going to go find some problems. Every home has a certain amount of bumps, warts and so on and so forth. So it doesn't mean that it's a bad home. It just means that it's got something like every other home. Those are things that you could work on in the future, your future list of improvements. You're not going to get an existing seller to rebuild your home to new construction standards and make it, I'm going to say, issue free. There'll always be a certain amount of issues that will be passed from seller to buyer, and you'll have to accept that. If you don't want to accept that, then you're going to want to just buy new construction and have the brand new shiny button right off the bat. But if you're buying existing, hazardous items are always fair game, and the sellers expect it to fix those normally. But other things that maybe where code has changed over time, but it still is functional, unless it presents a safety issue, you're not going to get the seller to change it. The risk to you also of not having a home inspection is that there'll be limited recourse to you because you'll be like, well, I didn't know about that. And the seller will be like, but you had every opportunity to do your inspection and you chose not to. So that's on you. So just know that I think an inspection is very valuable. The older the home, I think the more things you might want to inspect for, besides the basic home inspection, which is about $650, 50 pages and lots of pictures, takes about 3 hours. Besides that, on an older home, you might want to check the sewer line, you might want to check the fireplace chimney, if it has that, and or the electrical and some other things. So older homes have more issues and potentially will require more levels of inspection. Mistake number 6 is skipping the condo document review. Well, in Minnesota, you have 10 days to review the rules, regulations, and bylaws and all financials. And your 10 days don't begin until you've received everything. If you haven't received it, then your 10 days haven't started. You can get a copy of the rules from the Attorney General's office, and I have that website right in the middle of the page. You're going to go there, click on the publications link, and then from that, you're going to go ahead and review the 10 days. Here's what it looks like as far as page 1. And again, you can get all this and additional publications at the Attorney General's website. When we set up a search for you, which again, we're going to do based on your pre-approval, we put in the minimums. So what areas do you want to consider? What is the least acceptable features, like 2 bedrooms? Would 2 bedrooms work instead of 3? Well, 3 is preferred, but 2 would work. Okay, so then we're going to build the search based off at 2. Same things with bathrooms and, would 1 bathroom work? Well, yeah, but 2 is better. Okay, so we're going to set it up on the minimums. And then after we look for a while, if there are things that you want to change after we've been looking at homes, you're like, you know what, I decided I got to have 3 bedrooms. Okay, no problem. I go log back into your search, make the adjustments, and we make it 3. So it's very easy to change things. And I always like to make the search as wide as possible to show you everything, and then we start to narrow it down as time progresses. Down payment assistance programs are associated with the listings, and we talked about that. I showed you that little arrow, those 2 arrows off of my listing in Woodbury, where you can click on that link to find it. This is what it looks like when you click on that link. Resources I have for you, I have lots and lots and lots of them. If you wanted to read this book on secrets for successfully purchasing your first home, you could go to this website here and register and read it as a flip book. If we meet in person, I'm more than happy to provide you with a hard copy. But in the meantime, you can read it online via a flip book. These are the chapters inside the flip book. Lots of good information. I have another PDF for you, Building a Case for Home Ownership, that compares renting versus buying. I think the best time to buy a home is yesterday. Reason being is homes are generally appreciating. So over time, the longer you wait, the more that home will cost you. And the other thing is, as interest rates drop, if they drop, that will bring more buyers into the market, which will bring in more competition. The best time to buy is when there's the least amount of competition. I have other books, other resources from investing. That was my dog saying hello. um, from investing in real estate and also selling and downsizing. So I have lots and lots of resources. I also have a YouTube channel where I interview people that are involved with the housing process. You can go find me on YouTube and watch my interviews with people. I think I have over 300, lots of videos. I'm going to be doing one here later this afternoon on some special investor loans. So hopefully now you're excited, you feel confident and ready to go. If you would like assistance, I would like to help you if you'd like me to help you. So I can certainly help you with the real estate, and if you need assistance on where to find the financing, I can give you some names and guide you there as well. How do you get in touch with me? Well, you can call me, you can text me, you can email me, and you can go out to my Calendly link and set up an appointment with me. So go to Calendly if you'd like to do that, and then I'll call you back and confirm that, yep, that time's going to work. So the link is right here, Minneapolis St. Paul Homes /com I'm sorry, it's Minneapolis St. Paul Homes.net /book. Getting my websites mixed up there. But this is the one that you go to schedule it with my Calendly link. Of course, we don't discriminate. We want everybody to be a homeowner if you want to be a homeowner. And we're going to help guide you. And if today isn't the right time, we'll give you the steps so that in the future you'll be able to buy a house. So let's get you on that path. Whether or not we can make it happen today is going to be credit and income dependent, but we'll get you moving forward in the right direction. I have a little gift here. If you want to take a 7-question survey, I have a travel certificate. You would take a picture of this QR code, you'd fill out the 7 questions, and then I would send you a travel certificate to my favorite vacation spot, which is Las Vegas. And this is an example of what it looks like. There is a cost associated with it. You pay basically the room taxes to be at the hotel. At the time of this recording, it would be either the Westgate or the Rio, most likely. It's what they have for inventory. And then you have a certain amount of time to activate it and use it once you pay for it. So it's very inexpensive. So it's not free. The certificate is free. That's complimentary, but the cost associated with the certificate usage is very little, and there's no timeshare requirement presentation. So anyway, I have that for you if you're willing to take the survey. Here you can take a picture of my card or reference back to it. And with that, I'm going to stop my screen share and I'm going to open it up for questions. Are there any questions? You can either unmute or you can put them in the chat, whichever you prefer.
The only question I'd have, well, one of them would be, are you going to be posting the presentation along with the recording?
Yes, so I'm going to send this out to everybody that registered today. So you'll get one via email. I'm also going to be uploading it to my YouTube channel. So it would be available on YouTube for viewing sometime, probably tomorrow, I would say. I'll have that up by tomorrow. I'm going to try this afternoon, but we'll see how that goes. I've got a long list of things I have to do. So it'll be up within 24 hours and it'll be over to you in email within 24 hours.
Okay. The other question would be, and this might be a bit more personal, but how what would you recommend for someone when to get the pre-approval? Would it be talk to a realtor first, then get pre-approval, or get pre-approval and then talk to a realtor?
Um, Chicken and the egg, which comes first? The loan approval comes first. However, before you can go out shopping for a home. So the lender first. However, you may need to know which lenders to work with
Mm-hmm.
based on the programs that you want to look into. So I would say they're going to kind of happen at the same time. Meaning if we were working together, we would have a discussion about where you want to be based on your income, what's available, and then whether or not you want to use down payment assistance or a lender proprietary program. Then I would give you some names and I would say, talk to this person or these people. You would then make an application with one of those lenders and then they would get you approved. Then you would come back, meaning you would say, John, I'm good to go. I've been approved for $400,000. Let's go out and show me everything available in Egan, Apple Valley, and Rosemont. Then we're going to set up your search accordingly. So I think it's kind of a collaborative effort. Some of my competitors that work at other companies don't have 39 years of experience, and they're more of whatever the company tells them versus having the resources. So I think working with somebody that's been around long enough and knows the products and programs can provide you better guidance than somebody that doesn't. And not to name companies, but some of the other larger companies where they have the primarily in-house lender and in-house title company, and that's who they've used because it's easy, means that you're going to miss things that you otherwise could have been exposed to if that in-house lender doesn't have access to them. I'd mentioned my wife is at Wells Fargo. She is one resource to us. I have other lenders that work at mortgage brokers and lenders that work at other credit, I'm sorry, not title companies, and other credit unions and other mortgage companies that have different programs. So I'm about finding the right program for you and providing you the resources. So in that sense, that's what, I don't know if I really answered your question, which comes first. I think they both come together. But if you don't have the lender that you want to work with, or you want to get a second opinion on that, then I think you need to talk to a knowledgeable realtor that can give you their set of people who they work with, and then they can tell you why based on what you've told them on what you're looking for. So I think it's a collaborative effort, but after that initial conversation, it's going to go right to the lender of your choice to finish and to start and finish your financing.
Okay. Um, Semi follow-up question then. I mean, you thrown around a bunch of numbers of, this much of the down payment, this much of the down payment, what or of closing cost, what in just have you seen either recently or just in the past, how much of that is closing costs? So let's say $300,000 house closing cost can be expected to be what?
Sure. So that hypothetical example of Anita that we had in the slide,
Hmm.
um, that was about 2.5% of the purchase. So that's what I would use. So if it's a $300,000 house, that's going to be $7,500 or what you're going to have for closing costs. Um, Maybe a little bit more if we throw in your escrows in addition to that. So between 2.5 and 3% is a good rule of thumb. Now, the bigger the mortgage, the smaller that number is going to become. So if you're taking out an $800,000 loan, it might be 2%. If you're taking out a $100,000 loan, it might be 5%. So the size of the loan, but in that middle area, 2.5 to 3% is typically the number that you're going to use for closing costs.
Okay. Um, I think there's one other one I was going to ask, and that was, you showed it earlier with the market trends, but have you seen any, a dip and down in housing going in the market? Have you seen it going up?
Yeah.
Um,
Rates, yeah, right now at this time of the recording are in the mid sixes. They were just 30 days ago in the late sevens. A year ago, they were up to eight. So as the interest rates have dropped, more buyers are coming into the market and they were waiting. So when they were at eight, they're like, yeah, I don't want to buy at eight. So they didn't. Well, now that they're at 6.5-ish, all of a sudden they're back. And so the spring market, which is the busiest market time anyway, is getting very busy. So there's not enough homes, and we have this pent up demand that's only going to be getting more pent up as rates drop because more and more people will be allowed to enter the market at that point, which means more and more multiple offers, which goes back to why I think the best time to buy a home is yesterday, because if things get better in the economy, we're in an unacknowledged recession, in my opinion, when we have been for the last 24 months. So as rates improve, I think we'll get our way out of that recession. One of the things about real estate and why it's so important to the economy is that, and when you sell a home, there are a lot of ancillary things that come from that. You're churning, let's say, $500,000 throughout the economy. And with the velocity of money maybe moving by seven times, that's, maybe $3.5 million of monies that have moved through appliances and, roofs and home repair and painting and so on and so forth. So it's very, very important for our economy to have a good, strong housing market because of the ripple effect of those monies moving through it. And I think interest rates will default over time to 5-6%, which is the 50-year historical norm on interest rates. Right now, we're in we said the mid sixes. I think there's room for improvement. If those rates drop over 18 months, more and more people will come in. So in that sense, today you could buy, date the rate, you marry the home, and you refinance at a later date in time, if rates allow for it.
if it's a little before. Okay. Um, and you've mentioned a lot of down payment assistance programs, a lot of those. And normal to get out of the insurance is 20%, I believe you mentioned. What would you normally say, like, best you can do? What per kind of percentage should you kind of shoot for? before you would want to? If you're going for the 20, you get past it, what point do you say, maybe I should just go for it instead of waiting and waiting to build that down payment up further and further?
I would say if you can afford it and are comfortable with the payment that you're being shown, that I would buy the home as soon as I potentially could, which might be I can buy it with $1,000. I'm going to buy it now.
Mm,
Because if the home appreciates and I buy it a year from now, if it goes up by 3%, I'm going to have to pay 3% more. And then a year after that's another 3%. So I would say see what you're qualified for now and see if that dollar amount that you're comfortable spending will equal a house that you're comfortable living in now. And if it is, then that's when I would do it. I wouldn't wait to accumulate a larger down payment and hence having to potentially pay more in the future and
okay.
compete against more people in the future.
Okay. I don't have any further questions, but thank you for answering, as
Oh,
well as
you're
for the
absolutely,
presentation.
absolutely, Jake. Anytime and reach out to me wherever I can help you.
Will do.